Hello and welcome to Finextra. I'm Emily Horler and I'm here with Kanika Hope of Temenos. And we're at Next Gen Banking Nordics 2016 in Helsinki. Thank you for joining me.
Thank you, Emily.
How is disruption changing the structure of the retail banking industry?
Banking as we know it will fundamentally change. The age of end-to-end manufacture and distribution of all banking products and services entirely within a bank, those days are over. And bankers realize it. An incumbent bank has to look at every element of the value chain, look at where the costs are, what are the risks, what are the opportunity costs of divestment, and therefore decide what is their core business, what is it that they can outsource, what is it that they can collaborate with others with, maybe fintechs and other technology providers, and where is it that they can insource and be a utility provider, a partner of choice for banking services. There is a lot of fluidity. And the value chain is essentially disintermediating. Now this is a very good opportunity for banks because the smarter ones are going to use their traditional advantages, their size, their scale, their customer base and their proficiency at compliance to attract customers from the market and become a one-stop shop, be a full-service bank for their end customers. And it could lead to the rise of digital marketplaces where these banks partner with very large technology companies and create a platform like Amazon or Uber where distributors and manufacturers can come and sell their services.
So what can we expect the bank of the future to look like as a result?
So in this new world, banks have to move from competition to a collaboration mindset. They have to move from proprietary technologies to open standards. They have to look at historical product siloed organization structures, their processes, their systems, and convert them into a more customer-centric operating model. Now, what it really means is that they have to balance between customer-centric differentiation in the front office and efficiency-driven standardization in the back office. And this balance is a very critical thing because, as I said earlier, the distribution and manufacturing are diverging. Underpinning all of this will be their proficiency in data analytics. Data analytics is the world of the future. That's where the competitive advantage lies. And that has to flow across the bank, from the front office to the back office.
And why would you say legacy infrastructures in most banks are no longer fit for purpose?
In order to deal with the digital age, banks have built a lot of niche applications around their legacy. They have been loath to replace the core of the legacy because that is a hard thing to do. And with all these applications that sit around, with the interfaces, there has been a lot of complexity. It has about 4 or 5 different impacts. First of all, the costs are very, very high. When you have so many systems, you have to maintain all those systems. There are different technologies, competing technologies. You have to maintain different skill sets. You have to maintain a lot of manual processing because there are handoffs. So the IT costs of banks as a percentage of revenues are 11%. Whereas other industries, more mature industries that have been used to using ERP package software for years and years have 3 to 4%. So there's a quantum difference. Apart from that, most of the expenditure in banks is on run the bank, keeping the lights on. 70% of their expenditure is on that and only 30% is on growth and innovation, which is a serious issue in this age that we live in. The second is operational risk. So apart from technology obsolescence and skill sets on old technologies, you've got the very real issue of manual handoffs, which could lead to processing errors, and multiple interfaces mean multiple points of failure. So one example is the Royal Bank of Scotland in the UK, which had an outage because of a legacy batch scheduler, which affected 12 million customers for more than 1 week in 2012. The third thing is the customer experience. Now, as we know, in most other industries, customers expect seamless experiences, Amazon, what have you. They want the same experience from their bank. And if you start a journey digitally, you want it to end digitally. The fourth thing is data. We mentioned how important data was in this new age. It's very hard and costly to extract data from multiple legacy systems. They are hard to extract data from. There's a lot of duplication. There is no single version of the truth. And finally, it's agility. Legacy systems are not based on parameters, they're based on coding. So when you want to launch a product, you need months and months of coding. And that's not something that is feasible or cost effective in today's age. So those are the reasons why we believe at Temenos that ultimately the tipping point has been reached and sooner or later most banks will have to grapple with this issue of core technology.
Many banks have been reluctant to undertake core banking replacements. Why is this, and are their concerns valid?
There were a number of reasons for this. First of all, it was the maturity of the software packages in the early days. Software earlier did not have the functional breadth or the technology to integrate in current landscapes. So what pretty much happened was a lot of coexistence of the new package with the legacy, which led to complexity, which led to cost overruns, which led to time overruns. Meanwhile, business requirements changed in many of these multi-year programs, so scope creep happened. Today, modern package softwares have much more functionality. They are designed to be more parameter driven. They are designed with pre-configured content, and they are very easy to integrate. The second thing is that early implementations did not have enough skill sets. People did not have the experience to do projects of this criticality and this complexity, either at the bank itself or the system integrator or the provider of the software. And now there is a raft of successful projects around the globe. So many banks are undertaking them, so many have successfully completed them. JP Morgan, ABN AMRO, Nordea, to mention a few. All of these banks now are creating a real sort of pool of skilled resources that are in high demand. And with that comes lessons learned and do's and don'ts. So most people know that executive sponsorship is essential. They know early and frequent involvement of the business is very, very important. They know that you want to do migrations in certain phases. You want to build momentum around the project. Simplification of processes and products before you start the IT, which were not well known earlier. And the third thing is the business case. So waterfall models meant that business cases were hard to justify. Benefits came much later on, whereas the initial investment tended to be high and often exceeded estimates. Now you've got agile technologies, you've got cloud frameworks, you've got ways and means to accelerate and make the milestones more frequent, which means that the business case is more achievable in the upfront. Nordea, for instance, has designed its program around very quick decommissioning of legacy in each work stream, and that's going to yield a positive business case. Finally, with all these successful implementations, banks know that there are tangible benefits that have been achieved. So we did a survey along with Deloitte on comparing banks with legacy with those that have replaced their legacy. And there was a 20% difference in the ROE. It was better in banks that had replaced their legacy, and there was a 6% drop in the cost income ratio. So, executive boards and banks can now have the confidence that not only are these projects doable, but they actually yield positive benefits.
Kanika, thank you very much.
Thank you so much, Emily.
And thank you for watching.